Hey guys, Eric here, Mr. Fired Up Wealth. I know it's been a crazy week and a half here, so a lot of people are still panicking. Of course, we had a huge run yesterday, up 5%, and now down. It was 3%, now 2%. Things are going to be volatile for a while. Obviously, pick your battles. Try to find prices that you're happy with. Try to dollar cost average in. Obviously, you should have been doing some buying. Hopefully last week, especially on Friday during the lows, we hit about 28.55, 28.60 intraday on the S&P 500. That's when I was buying heavily. So if you watched any of the videos from last week, I did a couple of videos of what I was buying, and I started very small. So I'll use a very simple example because people ask me, how do you dollar cost average? Well, there's a couple ways to do it. The way I do it is a little bit different. And when I do it, when there's a drop in the market, I always try to have some cash. When there's a drop, once it drops about 5%, I usually start dipping my toe and I start adding. So let's pretend I add one share. Use simple math. So say I want to buy one share of something when it drops 5%. When it drops 7.5%, 8%, I'm adding, say, 2 or 3 shares. When it drops down 10%, 10 to 12%, I might be adding then 3, 5, maybe even 10 shares. So I'm going a lot harder as it drops. So hopefully you guys are in the group, in the Fired Up Wealth group, and you paid attention to that. I'm not just, buying aimlessly as soon as the market drops 5%. I'm doing it very strategically. So what am I going to show you today? A couple of cool things. So the portfolio's changed a little bit. I've added a lot more ETFs, especially on the retirement side. Everything you're going to see right here on this screen is from the taxable side. That's the taxable brokerage that's going to be used for the financial independence, retire early, for the fired. And I'm going to go through my top 20 holdings. And then after that, I'm going to show you 4 or 5 ETFs that I've been buying on this dip. And a few of them are still priced pretty attractively, and something that you might want to take a look at here. Maybe they'll even go lower. Who knows? So Amazon is my top holding. It's about 6% of assets in this portfolio. QQQ, that is the ETF from Invesco. It has a lot of FANG in the topper holdings. It's a NASDAQ 100 type of an ETF. That one's about 5% of assets in here. Microsoft, now we get down to closer to 4%. AbbVie, 3 to 4%. ITOT, now this is an ETF that I used to be gung-ho on, and I'm slowly converting that. I'm going to use the VOO, the VOO, the Vanguard S&P 500. I was doing ITOT and IVV because those used to be commission free with Fidelity. Now everything is commission free, so it doesn't matter that much. Cisco, I've actually added more, and that's the only stock on my top 50 that's red, even after the dip in the last week. So do I have more than a handful that are red? Yes, but they're not in the top 50 in terms of how much I own percentage wise the portfolio. So out of this top 20, Cisco's the only one that's red. I still think it's a $45 stock. It got down in the high 30s. Do what's best for you, but I think it's paying a 3.6% yield. Obviously, hardware is one of the first to get hit on any kind of financial downturn, so it's selling off anymore. But I think it was already, hammered pretty hard, and I don't know if you believe in long-term holding in DGI at 3.6%. With 5G on the horizon, with some cloud security opportunity on the horizon, Cisco could be something you can look at. Apple I've owned for forever. I don't know, 2014 or 15, I started my first position in Apple. Oracle, this is still from when I used to work at Oracle. I've sold a lot of it, but I still have a big chunk. It's about maybe 2.5%, maybe 3% of portfolio. Then Google, NVIDIA, AT&T, Splunk, which I've been adding heavily. So this would be something new in the top 20. So if you followed any of the older videos, I did a top 20, I don't know, maybe sometime late last year, 2019. And I'm pretty confident Splunk wasn't on there yet. Lam Research, that one is a really good one and good DGI. Salesforce, that one's probably new to this list, I believe. Home Depot has always kind of been here. Bank of America, it's probably fallen a little bit because it's lost quite a bit of its value, of course, with financials being hammered the way they are. The Treasury yield is actually for bonds is actually under 1% today, which is part of the reason why the market's going down. The Fed cut interest rates by 50 basis points today, and we had kind of a crazy reaction. So Costco, I've had this one for a long time. It's been going up this week because people are panicking with the coronavirus and stocking up with, supplies, food, and sanitizer and what have you, bleach. ServiceNow, Walt Disney, and Workday. If you were to go to number 21, it's actually going to be Boeing. That thing's dropped pretty hard. It's in the 275s or something. So I've been telling friends for a long time, can Boeing go lower? Sure. But if they get things figured out, which I'm confident they will long term, it's gonna make quite a few people rich buying it at, in the 250 to 275 range, in my opinion. So that is my top 20. Let's just kind of go through it real quick again. Amazon, QQQ, Microsoft, AbbVie, ITOT, Cisco, Apple, Oracle, Google, NVIDIA, AT&T, Splunk, Lam Research, Salesforce, Home Depot, Bank of America, Costco, ServiceNow, Walt Disney Company, and Workday. Now, there's probably there's probably 175 holdings in this portfolio. There's a lot of spec. So there's a ton of things in here, like, from Ringcentral to I've been adding, I added some Zscaler, I added Paycom, the Trade Desk, Teladoc. These would all be, closer to the top 30 if you start looking at those names. But there's a ton of other stuff, like any of the cannabis stocks that I own are very small positions, so those would be way further down the list. Some of those on the lower lists are up 300%. Some of them are down 50%. But the way that spec bucket works is if you get one that's a three bagger and you get one that loses half of its value, do the math, sell both of them, you're ahead. So it's not for everybody. It's kind of a way to hedge and to be able to gamble on some of those higher risk stocks. But you can see that my top 20 holds quite a bit of quality. If you look at, QQQ is going to give you dividends, Microsoft's DGI, AbbVie's DGI, ITOT's got dividends, Cisco is good DGI, Apple's DGI, Oracle's DGI, NVIDIA's DGI, albeit with a lower yield, AT&T is DGI, Lam Research is DGI, Home Depot is DGI, Bank of America is DGI, Costco is DGI, Disney is DGI. So there's a handful in there that don't pay dividends, like the ServiceNows, the Workdays, the Amazons. Up next, I'm going to show you some of the hot growth ETFs that I've been buying, that I've been telling other people about in groups and things like that I have been buying, that I think would be a possible something to look at for your portfolio. The first one is Sky, and you can see that a lot of the holdings in here I own, in my top 20, like Oracle, like Alphabet, like Amazon, like Microsoft. I do own some MongoDB. I do own some Shopify. I do, there's ServiceNow, there's Cisco, so if you're looking to kind of mimic what I just showed you, here's Splunk, IBM, which I own IBM's about a 1.5% position in that other portfolio. There's Nutanix, Paycom. I've been adding that one I told you about earlier. Zendesk, I've been adding that one. I've been telling you earlier. Here's Workday. It's in my top 20. I own some Visa at about Viva. I'm sorry. This VEV. I own about 1% of my portfolio on that one. New Relic. I own some of that. So I don't own all of these individual stocks, but I own quite a few of them. I've been buying this Sky. So the ticker is SKYY. It's First Trust Cloud Computing ETF. This is the holdings as of March 20th, 2020. You can see that, it's got 4.8% Microsoft, 4.6% Amazon, 4.5% Alphabet, and so on. Adobe, I own some of that, on and on and on. But this is basically like if you were to replicate the majority of the growth that's in my portfolio, 5.9 is in there as well. It's another good one, guys. Ringcentral. This would give you, if you're looking to, hey, I don't want to be as risky as Eric is, but this has 62 holdings that are cloud, focused, cloud computing, and maybe I'll buy, a couple percent, 5%, whatever you want in your portfolio to kind of have some of that exposure. That's something that you could consider. You got to do what's best for you. iPay is another one I've been buying, and this one's pretty straightforward, but it's Fintech. So it's got things like PayPal, Visa, MasterCard, American Express, Square, but then some other ones that maybe you haven't heard of, like this Aiden, Fiserv, you might know, Global Payments, Fidelity National Info. This is a really good ETF, and I've actually had it for several years. I'm up big on this one. I've been adding to it. Lit, I've also had this I had it for a couple years. It wasn't doing great. I sold it, and then I got back into it. I actually got back into it earlier this year, but I've been adding pretty heavily to it. It does have more of a little bit of a higher expense ratio at 0.75. It does pay a yield that's basically equivalent. So they're charging you a 0.75 and paying you a 0.77 yield. So it's kind of a wash. I'm holding this again in a retirement account, and you can see Tesla is about 11% of assets. You can see a lot of these, you probably have no idea what they are. Albemarle, you probably have heard this. This is 20% of assets. That's going to be, I believe it's located in Chile, and it's a lithium miner. So lithium and battery technology ETF, and it's got things like Panasonic that makes batteries, and then the Teslas, and then the actual mining and manufacturing company that mines and basically supplies the lithium. So that one's an interesting one. Don't go crazy on that by any means, but it does give you some exposure to Tesla. And then the last one I wanted to show you is ARK Web, ARKW. And ARK actually has a series of ETFs, so you can look. They've got the ARK Innovation. That's the ARKK. They have the ARKQ, which is Autonomous Tech and Robotics. They've got this one that I'm going to show you today, which is ARKW. They've got a kind of a biotech one with the ARKG, and then they also have a fintech one that's ARKF. And I actually want to look at this. So ARKF has Square, Tencent, Apple, Alibaba, PayPal, Amazon, Zillow. I mean, this is a great ETF too, guys. So you can take a look at that instead of iPay. I've just had iPay for a long time before they ever had this ARKF. I think it's fairly new. But I have been adding some ARKW to my retirement account. And the reason for it is it gives me some Tesla exposure in an ETF. And it's about 10.4% Tesla exposure right now. Has Square, which I like, Roku, Xilinx, which has been hammered. So this has some good upside potential, I think, with 5G and MIMO boxes. It's got so much exposure to China, and with Huawei, it's just been slaughtered. It has Twitter, it has Pinterest. Pinterest is something that, I probably wouldn't buy, but I like owning a piece of it because I actually think it'll grow. So it sounds counterintuitive, but I would rather own Pinterest and a Tesla and an ETF than just buying, a bunch of Pinterest. I do own a little bit of Twitter in that other account, but it's a fraction of a percent. Netflix, I owned for a long time and sold it for a big profit. I do like having exposure to it because I still think that has a growth story. Even with the Disney Pluses and all that, I don't think Netflix is going to go anywhere. 2U Inc. and then Splunk. And Splunk's one of my favorites. You saw that in the top 20. So there you go, guys. There's some ideas for you. I showed you my top 20 individual stocks from my taxable brokerage account, and I'm showing you a handful of ETFs that I think are good growth. Of course, you want to balance this depending on your risk tolerance, your suitability, your age. So I'm not suggesting you go out and buy a bunch of these, just all ETFs. Depending on what your goals are, you might want to mix in some VU, that's the Vanguard S&P 500, some VYM, which is Vanguard high yield. It pays about a 3% yield and has some a really good balance. Not a lot of tech in there. It doesn't have it has none of the FANG or anything, no Apple that I can remember. And it just has a lot of good exposure to other industries that you might not have if you're like me and invest in a lot of tech. So I do like VYM as a nice little hedge in there. If you looked at my retirement accounts, I'm going to have a mix of some of these ETFs, some of the VUs, some of the QQQs in there, some of the VYMs. I even have some other things like SCHD for dividends, DGROW, which is dividend growth. It's a iShares ETF. Own a little bit of ITA, which is the aerospace and defense ETF by iShares. So there's a lot of great ETFs, and it's important, I think, to have a balance of both ETFs and individual stocks. Hope you like this video. Please subscribe if you haven't. Click the bottom right-hand corner. Stop by Facebook, too, and search for Fired Up Wealth. There's a page, and then there's also a private group. Be happy to have you join us on there. We have some great conversations and things like that. So, again, thanks for watching. Have a great rest of your day. Take care.